I'm Ted Seides, and this is Capital Allocators. This show is an open exploration of the people and process behind capital allocation. Through conversations with leaders in the money game, we learn how these holders of the keys to the kingdom allocate their time and their capital. You can join our mailing list and access premium content at capitalallocators.com.
All opinions expressed by Ted and podcast guests are solely their own opinions and do not reflect the opinion of Capital Allocators or their firms. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Capital Allocators or podcast guests may maintain positions in securities discussed on this podcast.
My guest on today's show is Anne-Marie Fink, the head of private markets and funds alpha at the State of Wisconsin Investment Board, or SWIB, which manages $140 billion of pension funds in the state. SWIB is not your typical U.S. pension fund manager. It invests with outstanding governance, alignment with beneficiaries, delegated authority, a competitively compensated team, and cutting-edge strategies, all of which have contributed to a fully funded plan. Anne-Marie joined SWIB to lead its external manager efforts 4 years ago, following a career that spans both direct and fund investing. Our conversation highlights Anne-Marie's path, applying the skills of picking stocks to assessing stock-picking managers, the history and governance of SWIB, its unique payout structure that creates alignment, and their investment approach across portfolio construction, internal and external investing, asset classes, and risk management. Before we get going, Capital Allocators has entered the world of AI. We've trained a large language model on all our transcripts to help you learn anything you want from 7 years of conversations. We've affectionately called this model ChatGPT. It's safe to say Hank Morgan and I have no idea how to build an LLM, train data, and get the outputs that ChatGPT delivers. So a special thanks goes to our friends on the data science team at Atalaya Capital, who took on the development of the minimum viable product from start to finish. What they've done for us barely scratches the surface on how they're using AI to enhance their investment process, but I'll leave that to you to discuss with them. ChatGPT is the latest add-on to our premium membership. To sign up for a premium membership and access ChatGPT to query all our transcripts, go to capitalallocators.com. Thanks so much for spreading the word about ChatGPT. Please enjoy my conversation with Anne-Marie Fink. Anne-Marie, thanks so much for joining me.
Glad to be here. Thanks for having me.
Why don't we start with your path to investing?
So I was at a party actually in New York and met somebody who was an equity analyst and thought to myself, that is the coolest job in the world. I was already into Columbia Business School. And after that party, I was like, that's what I'm going to do at Columbia. And it just turned out that that was actually a pretty good place to do equity analysis. So I got lucky there.
What'd you do before business school?
So before business school, I worked for a number of years in a number of small businesses in New York, doing mostly marketing type stuff. And then I also took a year off and traveled. So did an around the world trip, which was really a lot of fun.
So what was it hearing about equity research that you thought it was the coolest job in the world?
The opportunity to be constantly learning is something that's always attracted me. I'm endlessly curious, I think. And I am actually fascinated by businesses and what makes them tick. So it was a combination of that. Also, I'm pretty balanced in terms of quantitative and qualitative skills. And so it incorporated both. So it was that package that made it really very compelling.
So what'd you find when you came out of business school and went to do it?
It was a lot of fun. I was at JP Morgan Asset Management on the buy side, and it was a great privilege because you got to meet with CEOs of the largest companies and was relatively young and relatively uninformed and got to ask them questions and think about the business challenges that they were facing. And at the same time, you didn't have to convince them to do anything. You could talk to them, figure out if you thought they were going to solve their business challenge. And if they weren't, you could just not participate in the stock. And if they were, then you could own the stock and hopefully go along for the ride with them.
How did you take those initial meetings, that beginning of learning about businesses, and start to learn about the investing world?
The thing about this business is it's very much an apprenticeship business. So you learn by doing, talking to people, making mistakes, and learning from them. So it was a combination of that. It was clearly learning about it in business school, doing a lot of reading, and talking to as many people as I could.
So you were on the direct side for a decade. How did you start to think about either moving over to the allocation side or what would come next?
There's a proximate answer and then a bigger answer. So the proximate answer is after about 11 years at JP Morgan Asset Management, I actually had an idea for a book. I had a friend of a friend who was a book agent. So I wrote a couple paragraphs and sent it to him. And he's like, great, let's do it. And I was like, what? So ended up taking about a year and a half off to write the book.
What was the book?
The book is called The Moneymakers, and it's about what equity analysts or equity owners want companies to do. So it's a general management book, but from the perspective of investors. And it came about as an equity analyst watching company managements and equity analysts and PMs talk past one another. And originally I was like, there's got to be a book out there because there's a management book about everything from how Harry Potter would manage a company to every great CEO, how they manage their company. But interestingly, I couldn't find a book about how the owners of companies wanted them to be managed. So that was the idea.
When you think about that lens, I immediately start thinking about activism and balance sheet management and profit maximization. What were some of the lessons that you wrote about in the book?
Some of them were around how investors think about timeframes. So a lot of company managements will complain that investors are too short term. And then investors will complain that management teams are like betting the farm and saying, come back to us in 5 years and find out if this massive bet that we made works. And really what investors are looking for is not that people can't transform their businesses, but that they do it in an incremental way, in a way where you take small steps, you make sure they work, and you get better and better over time, rather than I'm going to spend whatever, half my CapEx budget, and in 5 years, we'll find out if it worked.
Were there particular sections of the book that when it went out into the world and people started reflecting back that really resonated for others?
There were some. Now, to be fair, the book came out in 2009, and it was not a particular time when investors looked particularly smart. So my timing was not good. Certainly, the incrementalism, I think, was something that resonated a little bit. The idea that usually if there's one problem, there's multiple. So you really have to dig and not dismiss a little problem and think it'll go away. And then a third one that I think resonated a little bit with people was the idea that to create a successful and happy workforce, you actually need to be good at your job. And then the happiness follows, or to be successful in whatever endeavor you're going after, rather than let's make everybody happy and then they'll be good at what they're doing after.
How did you pivot back into investing?
When I was thinking about coming back, I wanted to leverage the skill set that I had used as an equity analyst, or that I had built as an equity analyst, but take it to the next level. And it was actually going into a job also at JP Morgan where I was analyzing long-short equity hedge funds was actually the great way to take that skill set, but then grow on it. And the thing that was so great about it was when I would meet with managers in that role, I could ask them, tell me what your top 10 stocks are. And there was usually a position in there that I knew reasonably well and could then dig much more into it with the manager. And any manager worth their salt doesn't really want to talk about their redemption terms or those kind of things. They want to talk about their stocks. So that usually would get a much better dialogue going. And then also I would find that usually any manager that tells you their bull case on their biggest position, it always sounds great. Where you really figure out who's got that something extra is when you feed back to them the bear case and say, well, okay, you said this is positive, but what about this risk and what about that risk? And how they respond to those risks, whether they've thought through them, if they've got maybe an early warning system for some of them. those are where you really feel like somebody's differentiating themselves. So it was really the ability to go into the fund selection business really grew off of the stock selection business.
So I'd love to pull a thread on that. And you know this from being on both sides. When a manager has a portfolio of stocks, inevitably they'll know some names better than others. You're picking out the one you know. What did you find about the consistency of when you were able to dig in, putting it in a context of the skill of the manager based on that one idea?
I'm a big believer that the details are where you really can figure out what somebody's doing. If you look at, particularly in the long-short equity space, if you look at everybody's book, the first 4 or 5 pages look exactly the same. We know our stocks better than anybody else, blah, blah. It's when you get into the details you can really figure it out. And some of the most shocking things were, once I remember feeding back to somebody the bear case on a stock, and they were just, well, my analyst knows that. So that wasn't a great answer. And then in other cases, I had somebody tell me a stock was great because the management team was buying back stock and they'd never done it before. They do it all the time. What are you talking about? Maybe they took a pause for about a year, but before that, they were serial repurchasers. So this is not that different. So it's things like that where you can really find out if they really know their stocks better than anybody else.
As you started to look at funds, what are the things that you might have thought you would have known from being on the direct side that you had to learn analyzing funds?
I learned a lot about different strategies and different ways of thinking about investing. So let me unpack that a little bit. When I was at JP Morgan, there was a very specific way that we analyzed companies. And like anybody, we had a very specific process. So what I had to learn in going to the fund side was there are multiple ways to analyze companies, and there are multiple ways to think about how you're investing. So actually, in some ways, I wish I had done that and then gone back to the direct side, because I would have been better at the direct side after doing that. But it was just interesting to learn that there are different ways to think through time horizons, to think through company analysis, to think through event management, catalyst management, those things.
So eventually you shift over to the public pension side at Rhode Island. What was that experience like?
It was great and interesting. So it was a big change, one, from going from a very corporate place to a government agency. I was a political appointee, and we were massively under-resourced. So we were doing everything by the seat of our pants. But it was also very exciting at the same time. I got to go even more meta. So if you think about my career, I keep going broader and broader. So started with actual companies, then went to stocks, and from stocks went to funds, and then from funds went to an entire portfolio. So it was really exciting to learn new asset classes, to really use some of the skills that I had developed as an equity analyst in looking at private companies or private equity. So it was all very exciting.
And then what did you find are some of the frustrations working at a public pension?
A couple of them were being under-resourced. So there were basically 3 of us that were managing $8 billion with consultants, but we were doing everything. I think we were hitting the broad side of the barn, but that's about all we could do. So that was one. And then the second was, at least in Rhode Island, the lack of trust in the government. So there was a real suspicion about what we as investors were doing on behalf of the pension. So there was a little bit of guilty until proven innocent, which is impossible to do. So there was a lot of concern that we were not managing the plan well. And at the same time, there had also been some pension reform. So people were already less than thrilled.
So take me through there and arriving at SWIB.
I spent about 4 years at Rhode Island. The treasurer changed. So I went to a multifamily office for a little period. It did not turn out to be a great fit. And then I also went to State Street, where they were managing some corporate pension assets. So that was an interesting opportunity as well. And then I was fortunate enough that the recruiter at SWIB found me. And SWIB is great because it's actually, to me, the ideal combination of the resources and breadth that you have in the corporate world with the mission and the opportunities to really impact everyday people's lives that you have as a public plan.
So what is SWIB?
SWIB is the State of Wisconsin Investment Board. So we manage the assets for the Wisconsin retirement system. We just do the investment management. There's another group that does the benefits administration. And we also manage a few other small pools of capital, but the main one is the WRS, the Wisconsin Retirement System. And we have about $140 billion in assets. So it's a very large pool given mid-sized state. I think we're top 10 in the country. And it is, I believe, the best set up plan in the country.
What makes it so well set up?
The main reason is because of how well aligned the incentives are. So the way the plan works, it's somewhat like a cash balance plan in that when you retire, you're annuitized at a minimum of 5%. But anything above that you get, rather than a cost of living adjustment, it's based on 5-year trailing returns. So any returns that we generate greater than 5%, a portion of that gets paid out to the retirees every year. So over time, that should grow. However, if we have a period of bad performance, sub 5 on a 5-year trailing basis, the benefits can actually go down. So because of that, the incentives are highly aligned, and there's a lot of interest among the pensioners and the pension system to make sure that the returns are high. So because the incentives are aligned, people are willing to get a more adept and therefore also more expensive investment staff. So we pay pretty well. We're able to keep people for a long time because the pay is relatively strong relative to other, certainly public plans. We have a lot of discretion. We also have delegated authority. So in Wisconsin, we have this unusual idea that investment decisions should be made by investment professionals, which relative to other public plans is somewhat unusual. So we have delegated authority, which is great because it means we can move fast. We can speak for investments. We don't have to say, well, we'd like to invest, but talk to us in a month after we've talked to our investment committee and we'll let you know. So it just makes us a much better group to partner with, and that gives us a huge edge.
So this idea of a structure set up to allow the investment team to invest, compensate people appropriately, have payouts that are aligned is not what you usually hear about, certainly in public pension funds in the US. How did this come about?
So the people who set up the system 70 years ago were just really smart. My understanding is that it was a bunch of insurance executives so that they understood how investments work. Because I think one of the biggest challenges in a lot of public investing in particular is people don't understand that things can go up and down. When Detroit went bankrupt, what was that, 5-7 years ago? You looked at the plan and the expected rate of return was 8%. And any year that they performed higher than 8%, they paid it out. So by definition, you're never going to get to 8% if you're capped at 8% and you can be below 8%. So it's not surprising that that lack of awareness on how investments work can create problems.
So when you have this setup where clearly people want higher returns so they individually can get a higher payout, but then they get hit on the other side if there's a drawdown, how do you balance the risk management part of not wanting the drawdowns with the desire for growth?
We seek to balance risk and return. When we do an asset allocation study, it's pretty standard, efficient frontier. What we're trying to do essentially is find the maximum point that gives the best return for the risk. That's usually actually a little bit less risk than we might want. So we apply leverage at the plant. We do a little bit less risk in terms of the assets that we own, and then we add back a little bit of risk through levering the entire plan.
I'd love to hear some about the investment philosophy of how you go about structuring the portfolio, making investments.
So we're really looking, it sounds very trite, but to maximize risk-adjusted returns. And we do that through a combination of the asset allocation, which, as I mentioned, we actually do use some leverage. We think that over time, it allows us to have a slightly less risky portfolio in terms of equities versus fixed income, but then we can get to the desired returns by levering it up a little bit. So that's one thing that we do. Second thing is I mentioned what we call the SWIB Edge. That is something that we think about a lot. So how can we make ourselves, particularly in the part of the portfolio that I run, which is all of our external investing, we think a lot about how we can make ourselves the best partner for the groups that we're partnering with so that we're getting the first call when there's interesting opportunities. And then we also do some management in-house, which we find is valuable across a number of fronts. One, it allows us to develop some of the expertise internally. Also allows us to keep some of our external partners honest by knowing that we can manage stuff in-house as well. So those, I would say, are some of the key tenets of what we're doing.
Let's dive into each of those. And the concept of the SWIB Edge for these external managers, what is it that you do to try to become this preferred partner?
So it all hangs together. Most of the people that work for me on at least the senior level have been there 10 plus years. So we have a lot of longevity. So we have really deep histories with many of the managers that we're working with. That's one place that we do it. A second place is, again, because of this delegated authority, we can be very responsive. When we're shown, for instance, a co-investment, we can respond within a couple weeks. Whereas I'll contrast that with Rhode Island, we did not have delegated authority. So all the decisions were made by what we call the State Investment Commission. So when I was there, we would talk to managers and they would say, do you want co-invest? And we would say, yes, we'd love to have co-invest, but I can tell you right now, we will not be able to respond in time. So we'd love to see any package you have around the co-investments because going back to my earlier comments about details, it's really helpful to see how people actually do their investing, but we're not going to be able to respond in time. And I think a lot of the managers really appreciated that because some of them came back to us and said, it was great that you said that because all the other people said they would do it and they couldn't respond in time either. That is not true in Wisconsin. In Wisconsin, we really can respond in time. Again, because it's a very short chain of decision making, we can move very quickly. So that's a key part of the SWIB Edge. And then I think another one is just what we call Wisconsin nice. We're nice people to deal with. Even if we don't want to do an investment, we try to be pleasant about saying no, and certainly saying no quickly if that's where we're going.
How do you think about what to do internally versus externally?
So our default position is to do things internally. But then there are three reasons that lead us to do things externally, and they're pretty reasonable, such that the portfolio ends up being about half internal, half external. So the three reasons that we would do something externally are, one, we just don't feel like we can do it from Madison, Wisconsin. So think emerging markets. All of our emerging markets we do externally. Second, we're looking for some diversification from what our internal teams are doing because the internal team may be great, but they're going to have a specific style. And we probably want to have some diversity of styles. So for instance, we have an internal team doing high yield. We also have an external manager that just does things a little bit differently. And then the third reason is just to be able to partner with the greatest investors in the world. So while I think Madison, Wisconsin's lovely, not everybody wants to live there. So we don't want to preclude ourselves from accessing the best talent in the world.
As you've gone through the iterations of this, what are the areas that you've chosen to invest internally?
So it's been equities, developed world large cap, and then US small and mid cap. We have some hedge fund strategies that we do internally, some CTAs, and then some other cap arb and things like that. And then the third area is fixed income. So we do investment grade, high yield, lev loans, and mortgage backs internally.
And then this last piece that's quite different is leverage. So you mentioned you can construct a portfolio that has less risk, put on some leverage. How do you think about how much to use and how to be sensitive to the interest rate environment?
We're currently at about 12% leverage. So we have 112% invested for every dollar that we have in assets. And that used to be higher when the yield curve was not inverted. It makes much more sense to do this when the yield curve is more normal. So we used to have about 15. The board has given us a range between 0 and 25. So 12 currently, 15 before, feels comfortable that it gives us some room if something happens and we want to be able to react, but at the same time allows us to put the position on in a big enough size that it matters.
So of that pool of 112% of assets, what does that composition of the portfolio look like?
So it's probably a little bit more fixed income oriented than it would be if we didn't have the leverage. So that's where we do the trade-off. But we're about 38% in equities, 26% in fixed income, 19% in tips, 30%, give or take, in privates. So that's 10 in private real estate and 20 in private equity and private debt. And that gets you to about 112.
You mentioned wanting to partner with best-in-class managers. How do you define what best-in-class means?
Well, it's always a challenge to figure it out, and it's always a moving target. It's a combination of a lot of things. It's a mosaic. You talk to them about how they're thinking about markets and how they're thinking about tackling different opportunities and how they think they can outperform, seeing if it makes sense, both in terms of what you know about the market structure and the competition. The one advantage that we have is we don't need to be the smartest people in the room, but because we can look at so many different strategies, that gives us an ability to figure out which ones we think are better. Making a relative judgment is a little bit easier than making an absolute judgment. So I would say that's the primary place where we start. And then you look at the numbers to see, does that support what they're saying? So if somebody says they're really risk controlled, and then you look at their numbers and they have a 40% drawdown, something doesn't quite compute. Or if somebody says they're really conscious about rates, and then you look at the regression against rate moves and it doesn't quite foot, then you know there's something a little bit off as well.
I'd love to walk through a bunch of the asset classes and just get your views of how you think about investing. And maybe we'll just walk through it like your background and start with the long-only world. So the obvious question there is active versus passive.
We're actually relatively big believers in active. So we do have about 20 to 25% of our portfolio in passive, mostly because we want to do all of our rebalancing in passive space. So we're also very rigorous about rebalancing each month. And we want to be able to do that without hitting our active managers all the time. So we keep some passive around for that. We also keep some passive around to help with the leverage. So we can convert it into futures, which gives us the leverage. And then other than that, we are pretty big believers in active. The one thing I would say we've been doing more recently, both internally and externally, is, well, externally more of a 150-50 type strategy. So we are trying to bring in some short exposure to one, because we think certain managers have some capabilities to think about, if I really like something, maybe there's a loser that goes with this. So that's one thing. And then the other thing why it's been salient recently is, particularly last year with the Magnificent Seven and the stock market being so dominated by 7 companies, it's been hard to be active because so much of your allocation gets eaten up by just even having a market weight in those 7. So what we find by loosening the long only constraint and going to extension strategies is it just gives managers more room to put on positions and have more opportunities to make returns.
So that lends itself into the hedge fund world, which you spent a lot of time in. How do you think about using hedge funds in your portfolio?
So we have a very distinct way that we use them, which is portable alpha. So we do not actually, and you'll notice when I gave you the allocation, there were no hedge funds in there. It's because we actually think of the hedge funds as almost an overlay. So we do the hedge funds as portable alpha. So we're looking for strategies that have little to no beta and really are absolute return type funds. And then we port that on top of equity and fixed income beta. And it works well because we're paying really high fees, but we're paying only on the alpha, the stuff that is hard to replicate. And then the stuff that's easy to replicate, the beta, because we do it passively, it's very inexpensive.
What types of strategies do you use?
So it's pretty much across the board. I don't think there's any strategy that we don't do other than long biased. So we do have long short equity hedge funds. We do have macro funds. We have quant funds. We have multi-strats. We have some relative value. And then we also do a little bit of specialty finance in there.
So a lot of those strategies, there is a package with a blend of, let's say, idiosyncratic positions and then some type of market beta. How do you measure and then manage the risks so that you can just deliver that portable alpha piece when you will have some residual risks in a portfolio like that?
So we're not maniacal about taking out all the residual risks. Certainly, if you think about macro in general, that usually is directional. What we're looking for is something that's not consistently the same direction. So if it's directional, today I'm long rates and tomorrow I'm short rates, and I'm good at it, that's fine. What we don't do is try to take out the betas underneath. Partly we haven't done it because operationally it's difficult. And then partly because if a manager tells us at the end of the month or even the end of the week that they're long something, by the time we put an offsetting position on, they might be short it. So it's too hard to try and offset it. What we do look, though, is over time, does anybody have a bias? And if they tend to have a beta bias, then they're probably a candidate to leave our portfolio.
How do you think about partnering with these managers to help the rest of your portfolio? So whether it's the areas that they find interesting or leveraging the skills of your internal team with your assessments of the external managers?
So we do a number of things. Certainly, we keep the dialogue open with our internal teams. If managers come to visit us, we make the meetings available to our internal teams and they will come join us. And it's actually helpful on both sides. So it's helpful for them to hear what other investors are doing. And it's also helpful for us to, after the fact, talk to our internal teams and ask them what they thought about the thesis, the thought process behind people's views. Because I said earlier that I used to be able to read back the bear case to somebody. I'm removed at this point, so I'm not as good at that. Bringing our internal team in is often very helpful on that front. So one of the things that we are doing is, since so many of our private managers are often IPOing or issuing publicly traded debt, we will often work with our internal teams. And if the internal team is interested in the allocation in the public markets, we will call up our partners on the private side and ask if they can help with allocations, which they're usually very willing to do because it's helpful for them to have a good pair of hands holding their securities. And we don't have a huge footprint in the markets. It helps us to get better allocations.
How do you think about leveraging your size, so the size of the pool at SWIB, to effectuate outcomes?
One of the ways that we try to leverage both our assets and, again, the delegated authority is by going into managers relatively early on. We have on occasion done day one, but we will often do year one investments. And we are willing to work with managers on what they're looking to achieve from a business perspective and what we are looking for as well. So let me give you a few examples. One, during late 2020 and early 2021, it was hard for some managers, particularly younger managers, to raise money on the PE side because everybody was scared about what was going on in the world. So we had some managers where we had made an initial allocation and we went back to them and said, okay, you're having trouble getting to your final close. What if we give you another 25 million? That'll get you close enough. And in exchange for us giving you another 25 million, one, you're going to close the fund and stop fundraising and start making investments. And two, we want better terms as a result of this. So that's one way that we've done it. Another thing that we've done is we partnered with one of our multi-pad hedge funds. They basically spun out their technology and created a separately managed account platform. So us and UTIMCO together basically anchored this new manager. And as a result of that, we were able to both help them to design the systems and the reporting and all of that. And then we also have favorable economics as a result.
So there's always a challenge when you have competition for capital, but defining best in class, you can look at people's records and teams and established managers, and then trying to plant some seeds early on. How have you thought about comparing and contrasting the two to receive allocations in your portfolio?
So we have a big enough portfolio that we're doing a little bit of all of the above. What we are somewhat different, I think, from a lot of people our size, particularly on the private side, is we actually are pretty big believers in lower mid-market funds. Now, it means we have to do more work. So that means the staff has to work harder. But we think that the opportunities in lower mid-market, if you've got the skill to really go in and assess people, we think the opportunities for returns are better. So it's a place where we've concentrated more of our efforts. Now, we certainly still do some mega managers because one, we have a lot of capital to put out. And two, there are some great mega managers out there. But we have tended to go a little bit smaller where we can have a little bit more control, where the opportunities for return we think are a little easier to access, maybe a little less competitive.
When you lay all that out, and there's a bunch of public documents, just in your private portfolio, there's like 12 pages of line items of managers. How do you process all that information effectively and make good decisions?
I have a great team and a large team. Whereas I said in Rhode Island, there are 3 of us basically doing it. I have 28 investment professionals working for me. So we just have a much bigger team. We've seen more stuff before, and we talk to a lot of people. It's a lot of hard work.
How do you think about private equity in the markets today, where you're seeing opportunities?
What we're seeing is the mega end of the market, it's harder to get liquidity. We had a period of frothiness there in 2021 where it was easy to go public. Everything was moving really quickly. And then we hit 2022 and we had a denominator effect because all of our portfolios went down. Nobody talks about this, but I think we also had a numerator effect in that everybody, GPs and LPs, we were all so excited in 2021 that everybody was raising bigger funds. We were making bigger commitments. It was just getting a little overdone. So now what we're doing is we're dealing with that. So now there's a bit of an overhang. The 2021 liquidity was unusual. And the 2023, 2024 liquidity is probably less than normal, but not vastly abnormal. It just feels vastly abnormal because 21 was so amazing. So in that environment, it's particularly more difficult for larger managers because you have fewer ways to exit. You really can only exit through IPO or through publicly traded company making a very, very large acquisition. Those don't happen every day. Whereas in the lower mid-market, where we'd be thrilled with $1 billion exit or even less, there we've got 3 avenues to exit. Some of them are big enough to IPO, but we're not dependent on the IPO markets. The other 2 ways that we can exit is 1, to a bigger PE shop, so another sponsor. And a lot of these companies are really quite manageable for that. And then 3, we can exit to a corporate strategic acquirer. And again, because it's a smaller bite size, it's easier for them to do that.
How do you think about incorporating venture capital in such a big portfolio?
So we like venture. At the same time, we recognize it's a much more capacity constrained strategy than anything that we're doing elsewhere in our portfolio. So our portfolio is relatively smaller. It's about $2 billion. We've also found that in general, there's more serial correlation with venture. So it's even more important in venture to be in the best managers. So there's a few strategies that we pursue to do that. One is the person who runs venture for me is a guy named Chris Prestigiacomo. He's the most friendly, outgoing person you've ever met. So he's just really good at making friends with a lot of GPs. And we're also playing very much the long game. Actually, that's true in everything that we do. We're playing a pretty long game, but particularly in venture where we prefer not to, but we will do $5 or $10 million checks to get a toehold with somebody and then try and grow it over time. So it's a combination in our venture portfolio of going after the who's who of venture. And there we're really fighting to just get some capacity. And then we have another portion of our portfolio that's a little bit more speculative. And there's 2 aspects to that. One is We have a Wisconsin venture portfolio. So we have a portfolio that is designed to either invest in managers that are based in Wisconsin or ones that spend a lot of time with Wisconsin companies. Now, unfortunately, I don't have a lower return hurdle for that. So we can't do everything that comes around. But we do spend a lot of time trying to foster the local venture ecosystem. So that's one thing that we do on the smaller end. And then we also will take a few shots a year on newer managers that we're hoping that we can get in early and then grow as they grow.
How are you thinking about the opportunities in private credit?
It's a very interesting space. We're active and I would say a little bit cautious. So on the positive side, if you look at the size of the publicly traded and then bank market, it does seem like private debt is not that huge. So you could say there's plenty of runway to go. On the other side, the private debt markets haven't really been around during a proper distress cycle because they really weren't of any size in 2008, which was the last time you had a real cycle. And even if you look at, there was a mini cycle in the energy markets in 2014, and there were a lot of distressed folks that didn't do so well in that period. So we're somewhat cautious on that front. Anybody that we're working with on the private debt side, we are looking for people that have some workout and distressed experience. I'm a little cautious around that, though, because everybody says they have it. And if it's been 10 years or 15 years, we'll see who's really got it. Another thing I would say that we're doing is we're generally not doing a ton in direct lending, the plain vanilla stuff, and we're doing more in mezz, more in distressed. And a lot of the distressed people that we're working with, we're giving them trigger funds. So that will give you a certain amount of money today. And if there's a real proper distress cycle, we'll give you more, but we don't want to pay fees if a proper distress cycle doesn't come around. And then interestingly, in our hedge fund book where we're doing specialty finance, some of that also looks like private debt, though it tends to be 3 years in terms of the tenor, and it tends to be a little bit more asset-backed. So that's another area where we're finding some opportunities. And one of the things that we're struggling with a little bit is, in general, we don't have a great home for anything that's 3 to 5 years. What we call private debt tends to go in 5+ years, and what goes into our hedge fund tends to be 3 and in. So we haven't done a lot in that space, but we are starting to see some opportunities there. And one of the advantages we also have, going back to the flexibility, is if we find something that doesn't fit a bucket, as long as we think it's interesting and the risk reward is valuable, we have a mechanism whereby I can go to our executive director and CIO. And if I can convince him that it is really interesting, we can find a home for it.
How do you think about the various real asset categories?
As I mentioned earlier, we have about 9-10% in real estate. So we're very active there. In energy, we've done it as part of our buyout portfolio. We've been underweight in energy, though able to respond when there's been some more interesting situations, which there have been in the last few years. We've also done some work there with alternative energy and solar and wind and some of the interesting things. So we're playing both sides of the energy transition. And then infrastructure, we look at it every 3 to 4 years, and we haven't quite gotten excited enough to pull the trigger yet. There's a few reasons for that. One is our ability to invest in illiquids is not infinite. So if we were to do something in infrastructure, that would probably take away from either PE, private debt, or real estate. And then we'd have to also build up a team there. So we haven't done anything per se. However, we are dabbling in some things that are crossover between real estate. So data centers we put in our real estate portfolio. Other people might call it infrastructure. We're doing some of that.
As you look at some of these one-offs and opportunistic things that come up, what are you most excited about?
So some of the things that we're most excited about are the separately managed account platform that I talked about earlier. And part of the reason we're excited about that is it also allows us to take a page from the multi-pads and notionally fund things so we can be much more capital efficient. So that's really interesting for us. Another thing that we're interested and excited about is on the private side, there's been less capital available and many people are still a little bit over their skis. We're finding some opportunities to partner with people and do more interesting things. So we recently helped a group get a secondary strategy up and running, and in exchange got really interesting economics out of that.
As you've built the platform, the multi-pad platform, how have you found the competition for talent when these pod shops are so large and doing everything they can to suck up all the talent in the hedge fund space?
Part of the reason that we did a separately managed account platform now and not in the past, because they've been around for a while, is we feel like now that there's not negative selection bias on the talent. So what we're finding is there's a lot of folks who are high quality managers, often worked at those multi-pads, and for whatever reason wanted to go out and hang out their own shingle. Sometimes they've hung out their own shingle and their former multi-pad is still investing with them, but they're willing to take money directly from us. And they tend to be folks that are not very excited about doing the marketing. So if they can get to $1 billion or so in assets, they're happy just running that. So that's a manager that we really like because the incentives are very much aligned. We can be very important to them. They're important to us. And they can just focus on the investing, which is what we want them to do.
So oftentimes, or at least by reputation, when a manager leaves one of the platforms, it's because of a drawdown, and certainly how some of the risk rules work. Have you found doing your diligence effectively so that you can get comfort that even though they were, let's say, pushed off, or maybe they said they left the platform, that you feel like they'll be able to produce in the future?
So it's a combination of reference checks. We're talking to as many people as we can to determine whether they really left voluntarily or not. About 8 of the 10 that we started with actually have been running money for a little while on their own. So we can look at their track records. And then the other thing that we really like about the managed account platform is that we can watch them. So we can see every day what they're doing. And I think that's been enormously helpful, both for the managers, because we can take a slightly longer time frame than maybe some of the multi-pads can. So for instance, we had a manager recently who there was a situation that they wanted to go above their risk limit. It was something that was going to IPO. So there was a relatively short window on it, though not IPOs can go wrong, but it had a relatively short window on it, but it was definitely above their risk limit. So they could come to us and say, here's the situation. Do you agree? And we agreed. And they held it for about a week and we made a lot of money off of it. It's also been, I think, enormously helpful for our team to watch what the managers are actually doing. Because it's one thing, again, to see the pretty pages in the flip book that say, this is our philosophy, this is our process. But then when you watch what they do every day, it gives you a much better feel for who they really are.
So you have these managed accounts that have all this transparency. You've got all your internal teams in all those positions. You have these external accounts across asset classes. When you roll all of that up to look at the risk of the WRS as a whole, what tools are you using to assimilate all of that information?
So let me just be clear about one thing. Our internal teams don't see what the positions that our external managers have. So let me be clear about that. There is a Chinese wall there. We're using a number of different tools. So one is we have a risk team that uses primarily FactSet to look at what the exposures are across the board. Another thing that we have is we added a position we call portfolio engineer about 2 years ago, and it's been amazing. So essentially what our portfolio engineer is, it's an investment professional who sits between me and my investment staff and our technology team. So somebody who can speak both investments and technology and has created a number of systems and reporting that has transformed our lives. So we can see things more clearly now. When I started at SWIB a little over 4 years ago, I met with my senior folks and asked each of them what their pain point was. And by far and away, the biggest pain point was reporting and pulling information together. We now have systematized a lot of that. And so it's given us a lot more time, the ability to look through things. It's really been transformative. I recommend for everybody to get a portfolio engineer.
Once you had all that built with the portfolio engineer, what did you find that you might not have known before?
Well, we have 12 pages of private equity funds. No, I kind of knew that. It's the ability to dig in on things very quickly and look both at a broad level and then drill down has been very helpful.
So SWIB for a long time has been fully funded. It's quite different from a lot of public plans, though many are catching up. What are the ramifications in your day-to-day, year-to-year of investing with a fully funded plan compared to an underfunded plan?
I think it allows us to focus on the investments and be more pure about risk-adjusted returns rather than either trying to shoot the lights out with an idea of we're going to go for broke here and really take a lot of risk, or say, given that we're so underfunded, we can't take any risk because if we get even more underfunded, we're possibly going to have a problem. I think in a lot of places, too, you have to, not recently, but if there's another downturn in the market, I think a lot of places will be spending all of their time thinking about, well, can we fund this? Do we have to go to the legislature and ask for more money or things like that? So it just takes away from your ability to focus on the investing.
Now, it turns out this isn't your first rodeo on a podcast because SWIB has created the SWIB podcast. What was the thought process behind creating a podcast highlighting the people inside of SWIB?
Going back to the incentives being aligned and the shared risk model that we have with our pension participants, that only works because there's a lot of trust. And in fact, other states would love to set up a similar system, but there's just not enough trust between the pension participants, the taxpayers, and the investment professionals to set that up. So we understand how important that trust is. We recognize that we've built it up over 70 years, and we don't want to do anything that would damage that trust. So one of the ways that we try to keep that trust intact is through the SWIB podcast, is to share with people what we are doing so that they can understand that we're not perfect. We're going to make mistakes, but the mistakes, if we make them, are not coming from a cavalier attitude, that we are very focused. We understand how important this is for people and for their retirements. And we're going to do what we can to deliver returns for them.
So you mentioned that a lot of other states would love to have this model of aligned interests, but Wisconsin started it so long ago that it's worked. A lot of people feel like the public pensions are broken in their ability to invest the way you have. I'm sure you have a lot of these conversations with people at other states. Where does that potential come to improve the model in the way that SWIB has at some of the places that haven't been able to do it?
I think there's two ingredients. If you look at CalPERS versus CalSTRS, one has had very long, steady leadership, and the other has had a lot of turnover. So it's easier to do more innovative stuff when you feel like there's a steady hand on the tiller. And that's the other thing about investing, is that there are multiple strategies that work. What doesn't work is changing the strategy every 2 years. So the longevity is really important, I think more so in investing than in many things. The second thing is, the two go hand in hand, but building up that trust, and that you do incrementally. You can't build 70 years of trust in a couple of years. What you can do, though, is make incremental improvements and then have it get a little bit better. And then maybe people will believe you more when the politicians often have their own logic and their own motivations to make changes. And if the system and the participants in the system feel that you've done a good job, then they're more likely to listen to you. If they feel like you haven't done a good job, then it's harder. So you just have to build it up slowly.
As you look at over the next couple of years, what are some of the areas of innovation that you're leaning into to continue to develop the investment program?
So we talked about our separately managed account platform. The other area that we're spending a lot of time, and I think we'll be spending more time going forward, is on the privates in co-investment, both co-investment as it is, which is an area that we've been good at, but really have ramped it probably over the last 7-8 years. And we think that there's more opportunity there. And then there's a bunch of ancillary things that go along with that I think are going to develop, which is, I used to call them unnatural liquidity from private equity. So if you think about private equity firms, we're seeing a lot of selling off partial positions or selling off a majority but holding a stub position. We're seeing continuation vehicles, and we're seeing NAV loans. All of this is in an effort to get more liquidity, which is a bit of a collective action problem because we don't need the liquidity. We're actually growing our privates allocation at the moment, and we're happy to do that. So when people are giving us unnatural liquidity, we're not very excited about it. But I had an aha moment recently where I think these are going to become more and more parts of the universe going forward. They're not going away. So we need to get better at figuring out how to assess a continuation vehicle, how to help do our part as part of the industry to figure out what are we going to do with all these stub positions and where are we going to ultimately get liquidity. So I think there's a lot of stuff around that. And then the third thing I would say is around secondaries recently, again, because we're in a good position to take on more liquidity. And as those markets continue to develop, we hope to be able to do more.
Where do you think these various stub positions, liquidity needs in the private markets unfold over the next few years?
I think it's going to be fascinating. I don't have a good answer for it. And whenever I ask managers, I would say I haven't gotten a great answer from them either. It's an interesting challenge because I do believe that the governance model of privately held companies is better than the publicly traded governance model. And the difference has only gotten starker over the last 20 plus years that I've been doing this. So I think there are challenges in the public market, which means private's going to continue probably to grow, but there's still this liquidity challenge. So there's going to have to be some solution. The industry has been feeling around for something. What was it, 5-8 years ago, there was the whole wave of permanent capital vehicles, but nobody really liked that either. So I do think it's something that the industry is going to have to try and figure out over the next few years.
Well, it's going to be, as you said, fascinating to wait and watch. Anne-Marie, before I let you go, I want to ask you a couple of closing questions. What is your favorite hobby or activity outside of work and family?
I love to travel, and I'm a big reader. So traveling both without moving and then by getting on airplanes.
Any particular places to go?
I probably was a nomad in a prior life. I have loved Australia, have loved Japan, China, Europe, Africa, a little bit of everything.
What is one fact that most people don't know about you?
I have no idea. I have no fact that nobody knows about me. I don't know.
What's your biggest pet peeve?
What I find challenging is when people are inconsistent. I was talking to a manager not that long ago, and they were telling me how I shouldn't worry about fees because all that matters is after fee returns. And then we were talking later in the conversation about this great investment they had made because they got half fees because they were an early investor. I was like, okay, so we know that after fee returns, fees are part of after fee returns.
Which two people have had the biggest impact on your professional life?
Probably Susan Ulick, who was the first manager I had when I was an equity analyst at JP Morgan. And then the other person I would say is Gina Raimondo, who was the treasurer at the state of Rhode Island, who brought me over and had faith that I could figure out these other asset classes and run a total portfolio for the state.
What's the best advice you've ever received?
Keep going. So when you have a mistake, you just got to pick yourself up and keep going.
All right, Anne-Marie, last one. What life lesson have you learned that you wish you knew a lot earlier in life?
I think the thing I wish I knew earlier was, it sounds obvious, but the 80-20 rule is that just get 80% of the way there and you don't have to get it perfect. I think that was something I wish I had figured out a lot earlier.
Anne-Marie, thanks so much for sharing this incredible success story at SWIB.
Thanks for having me.
Thanks for listening to the show. To learn more, hop on our website at capitalallocators.com, where you can join our mailing list, access past shows, learn about our gatherings, and sign up for premium content, including podcast transcripts, my investment portfolio, and a lot more. Have a good one, and see you next time.